It was another very busy week on Wall Street. The Federal Reserve raising rates, that was expected. Chairman Janet Yellen cautioned investors on inflation despite the strong economy. What does it all mean? Jim Grant is here, the editor of Grant's Interest Rate Observer, and he joins me right now. Jim, it is great to see you.
Maria, nice to see you.
Thank you so much for joining us this morning. We really wanted your insights on interest rates this weekend because as we're talking about this great economy, you look at the 10-year and it's just a quandary. Why rates are so low, and your interest rate observer, Grant's Interest Rate Observer, titles the latest case of the 0% junk bond handle. How do you see rates?
Well, first of all, rates are prices. Interest rates are prices, and they are I think, the most consequential prices in capitalism. They define investment hurdle rates, and they kind of measure financial risk, and they discount future cash flows. So they are very sensitive prices, and they happen to be under the thumb of governmental authorities the world over, our Federal Reserve, the Bank of Japan, and of course, to my mind, the most meddlesome of the three now is the European Central Bank. These rates in Europe are extraordinary. I observe interest rates for a living, Maria. That's my. We all have to have some job.
I know. That's why we love you.
I thought that I had seen it all. I had not seen it all, because in Europe there is something called Telecom Italia.
Yes.
Which, as you might surmise, is a telephone business in Italy. And it has speculative grade debt, high speculative grade debt to be sure, but still junk bonds outstanding to mature in the years 2022 and 23. And the yields, Maria, on these not quite investment grade securities are less than 1%. So 0% is the way you begin to describe the yield of maturity. One is, I think, 0.9 something, the other 0.6 something. But bear in mind that the rate of inflation that Mario Draghi insists we must have, he doesn't explain why. He says you have to have 2%, and so that's less. So these yields are less than the expected rate of inflation, the rate of inflation the central banks want to impose. And
what does that tell you?
And it gives you no cushion against the credit risk inherent in a low-rated security. Yeah. So these are purely uneconomic yields. And they are the world. I mean, so Europe is 3,000 miles of salt water away. We say, that's Europe. However, through the agency of arbitrage, these rates are, to a degree, everyone's rates. So they really feel great. I mean, so everyone can borrow like for nothing. Isn't that fabulous? Maria is Bartiromo. You should know, ladies and gentlemen, she is an author as well as a TV personality. And in your excellent Wall Street Journal column, you enumerate many of the good things that are happening in this country. But one of the darkening clouds I submit, and I'm an expert on darkening clouds, that's what I do for a living, is the distortion of these important consequential prices by the central banks specifically, and I'm calling you out, Mario, by the European Central Bank. Very dangerous.
So, I mean, in my op-ed that you referred to in the Journal, I point out that right now we're seeing what we haven't seen in a long time, and that is a synchronized global growth story. I mean, there are firms that are predicting 4% growth next year, and yet when you look at where interest rates are, it's not telling the same story.
Well, consider the alignment of forces we have in the world today. We have boom time equity valuations by some measures, the second highest only after the late 1990s. We have graveyard quiet and volatility. Perfect peace and quiet in the measures like the VIX, which measures the Sturm und Drang in the stock market, right? There's no drama in the stock market. It's just up every day except the weekends, and maybe we'll get around to fixing that. Okay, so graveyard volatility, boom time equity, and depression level interest rates.
Exactly.
By some measures, Maria, the sovereign debt yields are the lowest in like 600 or 700 years.